And Jeff, now it's time to welcome our final guest, income specialist Anthony Saccaro. He's a lawyer, but as I always say, we won't hold that against him. But he's also the founder and president of Providence Financial and Insurance Services, a retirement income store located just outside of LA. And he's author of the new book, More Life Than Money, which is coming out shortly. Anthony, thanks so much for being back with us here on The Income Generation.
Thank you for having me.
Newly published author on deck, getting ready to be, right, Anthony? So it's been a tough year. How would you say most of your clients are feeling right now at the midpoint of 2021? Are they optimistic? Are they worried? Are they hopeful? Because the markets have been resilient.
You know, I feel like my clients actually have more common sense than the politicians. My clients know that this can't go on forever, and we're coming out of this. You get the sense that we're coming out of this euphoric period where the government's pumped, $5 trillion or whatever amount that is into the economy. That's boosted the stock market. Everyone except the politicians seem to know that this can't keep going on. And I find that most of my clients are actually nervous. It's that sixth sense within them, but they don't really know why. But I think they need to pay attention to it.
I have found the exact same thing down here in Florida. It's odd that California and Florida consumers are aligned in that sense, don't you think?
Yeah, Florida and California are very similar, but the reality is most of the times people out here in California are a little bit goofy to begin with. So when they start thinking that things might be, going in a bad direction, or they start getting worried, then I think the rest of the country should follow suit.
Well, you said something funny before, Anthony. You said your customers have more common sense than the politicians. I'm not going to touch that. We'll just chalk that up as a funny. But tell us what your outlook is for the next 12 months. You're going to see the Fed tapering. Are we going to see the economy stand on its own? Are we going to flatline like we did after October of 2014 when the stimulus ended? What do you see happening?
That's more of a difficult question today than it was even a year ago, I would say. The reality is it's very difficult because you've got so many competing forces. You still have this money that has been printed, that is in the economy, that is a big boost for the economy, and interest rates are still low. But the Fed has indicated that in a year or two, they might raise rates. Inflation is starting to creep up. That's not good for the stock market. My best guess is in the next 6 to 12 months, the market will stay at this level or even climb up a little higher. But then after that, I have no idea. All bets are off. It's probably going to be some choppy waters if I had to guess.
Well, it sure does feel like the mother of all asset bubbles, though. I mean, everything is skyrocketing from real estate to corporate bond prices to the stock market. Inflation, like you said, is starting to run rampant to a certain degree. So with not much more money being lent, and that's a scary proposition, Anthony, that means we're coming to the pinnacle and there's going to be a capitulation back down, a reversion to the mean at some point.
That's exactly right. The money's what's been leading us out of this recession. There's a big canyon right now, the Grand Canyon, if you will, between where the stock market is at record highs and where the economy is with still unemployment and very low levels. And the bottom line is this canyon is being filled with all the government's money. That's the only thing separating it. So if you quit putting the money in the canyon, which is what's going to be happening here soon, then the stock market has absolutely the possibility of retracing back to meet the economy, because these two things are supposed to be hand in hand, and right now they're not.
So bottom line then, your clients then aren't much different from Jeff's, aren't much different from mine. They're at the stage where they need to be making that shift from the G to the I, from growth to income. Bottom line, what are you telling them today as they prepare for retirement?
Well, I'm generally reducing the risk of most of my clients. Most of my clients have 30% or less of their money in equities at this point. And even if you do want to participate and have some growth, and even if you can afford to take the risk, when you look at the numbers of dividend-paying equities versus non-dividend-paying equities, there's really no comparison. I mean, over the last 50 years or so, they've returned 50% more, and there's been a third less volatility. If you look at the last 40 years and you look at the S&P 500 with dividends versus without dividends, the stocks with dividends are like they pay like 5 times more because of the compounding. So you can still get growth, but I would focus on dividends in the equities that you have, and it makes it safer and it reduces your volatility. So less stock and higher quality stock with dividends. I think that's the way to go for most of my clients.
And that's something I'm sure that people shortly will be able to learn more about by pre-ordering a copy of your new book, More Life Than Money. And you do that by going to morelifethanmoneybook.com. Anthony, thanks so much for being back with us.
Thank you for having me. Great to be here.